Well, this week here we are finishing up the big banks. And the banks have lied to us about their earnings. You can call it a white lie, but they did lie. They're not making money, even though they came out and, wow, they're all excited, right? The fake Biz News Network. Boy, look at this. They beat their top line, their middle line, their bottom line. They beat everything. Wow, they beat their expectations. What a bunch of crap that is. They lost money. Now, let me prove to you how they lost money. But first, let's take a look at the overall economy, what's going on. This is not good for banks. When you have a situation of Bidenomics, as they call it, and we have a foreclosures already up 34%. We have real wages. They declined 24 of the past 32 months. That's not good. We have corporate defaults. Corporate defaults up 176%. Am I surprised? Of course not. We've been feeding them interest rates at zero for 13 years, from 2009 to 2023 or 22. So the corporate defaults, who wouldn't think there'd be corporate defaults? But here's the big thing, is the bank defaults. And here's what they're not telling you. When the banks defaulted, let me show you. If you recall, let's go to the chart here for a moment. Okay. And let's take a look at these banks for a moment. If you remember, after we had the crash, after that big run with zero rates, and all of a sudden rates climbed from zero up to 1.5%, that didn't work out so well, did it? No. And once you got to that 1.5%, there was resistance. And the market started to collapse. We went down to the October low there, that infamous 13th low, okay? Because we went from, think about this, we went from here at 1.5% on 10 years, we went down to here to 4%. So it was going from 1 to 4%. That's why the market was dropping. There was no more zero rates. Why? Because it created so much inflation, he had to start raising rates. Powell. And even worse, the 3-month, the short rate, remember, was all the way up here, was at zero, and then it started to go from 0.1% down to 4.1%. Can you imagine that? That's insane. That's why it failed. As they started to move the market, how'd they move the market up here? Because when rates are that high, remember, it's the 7 tech stocks that drove the whole market. Out of 500 stocks, 7 stocks drove the whole market. So they tried it again. They said, let's put a pool together of $15 billion. This is Powell and the boys. And let's take the tech stocks and drive the market, because everybody buys tech stocks. We'll get it back up. But then they had a problem. They entered into the bank problem. Why? What happened with the bank problem? Well, guess what? As our friend Powell kept raising rates to fight inflation, all of a sudden we saw 3 banks get into trouble. Silicon Valley Bank, First Republic Bank, and Signature. Why? Well, because like all banks, big, small, what do they do with their deposit money? What do they do with the money that you, the depositor, gives the bank? They take the money and they buy bonds. They buy mortgages, put on their balance sheet, and they get an income from it. But there was a problem when the market dropped from here to here, because rates were going from 1.5% to 4%, and then from 0.1% to 3 months to 4.1%. The market couldn't withstand those kind of rates. nor could the banks, because the banks now were losing money. And the banks, the three banks, when everybody started to see the rates going up, they said, "Oh, look at this! I can go now, and I can get a 3-month Treasury. I can get a 3-month Treasury for 5%, 4%. I'm only getting 1.5% for the bank." So depositors at the three banks, at the again, Silicon Valley Bank, First Republic Bank, Signature Bank, they walked in the bank and said, "Oh, I want to take my deposits out. I want my savings, my checking, I want my business, I want to pull it out." And they had to say, "Well, we can't do that." Why? Well, the way it works, all deposit money, all banks do this, sir. We go and we buy bonds, and we go and we buy mortgage-backed securities, but there's been a problem because there's been so much inflation because the president, what he did with oil and gasoline, and so the Fed had to keep raising rates to fight inflation. All of a sudden, we're sitting here with our mortgage-backed securities, we're sitting here with our bonds, and guess what? We're losing money. So so if we wanted to give you a deposit back, we'd have to sell the mortgages. We'd have to sell the bonds. Can you come back next week? I mean, make an appointment with us, and we'll tell you when we sold them. Of course, they can't do that. So that's when Powell came in and he said, "Oh, don't worry, we'll take care of all the depositors." They printed all the money, shoved it into the three banks. Depositors happy, they got their money out. But what happened to those three banks? The stock tanked. But there was another 180 banks he didn't tell us about, had the same problem. But he didn't want those stocks to tank. It's an election year. He didn't want those to tank, right? So what does he do with the 180 banks having the same exact problem? He prints $2 trillion, and he puts it in a fund called the Bank Term Funding Program, which in 2008 was called the Term Security Facility. And now, out of the 180 banks, when a depositor came in and said, "Hey, I want to take my money out because you're only going to give me 1.5% for 90 days on a CD, I can now get 5%. I want my money." Here, no problem. They had plenty of money. Unlike the poor three banks, Silicon and Republic and Signature, they didn't have it. So that's what they've been doing. So what happened? Well, they wanted to push the market up. Now they got the story to see, look at it, the banks all got bailed out. Nobody got hurt. All the depositors, they didn't get hurt. The banks, all these 180 banks are getting bailed out. And tech stocks start rallying. What? Why would tech stocks rally with high yields? High yields to tech stocks is like kryptonite to Superman. But they went up. Tech stock. But how many stocks? Out of the 7 magnificent stocks, magnificent 7, 3 out of the 7 were driving the whole rally. Microsoft and Apple, they're going up in spite of the fact that we had all these high yields. Well, guess what happened? Now rates are going up even more. And this is why they could never get back to here. This is why the crash has already started. This is why every time they rally, it failed. Rally, it failed. Rally, it failed. Rally, it failed. Now we're in this last quarter. This quarter now, right? They're getting earnings. And the banks go, "Oh, look at this. Citibank's reporting. Wells Fargo's reporting. Wow, they beat all their estimates. Look at the profits they're making." They're lying. They're not making profits. See, the difference between them, the big banks, and the small banks is the big banks, they have enough money when the depositor comes in to give him his money to go out and buy a 3-month Treasury if he wants from the government at 5%. They got plenty of money to give them. And at the same time, what they're doing is, unlike the 3 banks, Silicon and Republic and Signature, they can hold on to all their losses. So while they're telling you they got profits, they don't. It appears they got profits because they don't have to disclose the losses by law, as long as they keep it on the books. But see, those 3 banks, they couldn't do that. They had no money. They couldn't pay depositors. And the 180 banks that are in deep trouble right now, They're doing it now temporarily. They're being taken care of. They give money to their depositors because remember of that program, the $2 trillion is propping them up. So now this quarter, I was so angry when all these banks are coming out. But look at this. Watch this. When JP Morgan comes out, not holding, is it? You think somebody would question that? Why isn't JP Morgan, if they're doing so good, why aren't they holding? Why isn't Citi holding? Why isn't Wells Fargo holding? These guys should be taken off. Bank of America, are you kidding? Look at that. That should be, you can't even get up to the resistance. Why? Because, see, the big institutions know what I'm telling you is true. They don't have profits, they have losses. And at some point, they're going to have to take and disclose those losses, just like Silicon Valley, First Republic, and Signature. So this is nothing but a bubble. It's a big bubble. That's all it is. So we're being lied to. Now, here's another big problem with the banks. The other big problem with the banks is real estate's going to hell. That's right. Because think about this. If you bought a home for $350,000 when rates are mortgages at 2.8%, you had a payment of about, I don't know, $1,300, we'll say. So you bought a home, $350,000. You put 20% down, and your payment would be $1,200 because your rate's 2.8. But now rates aren't at 2.8. Rates are at 8%. So your payment's going to be $2,000. Well, wait a minute. Something's wrong here. Then the price of the house has to come down. So remember, from 2020 to 2022, a house that was at $350,000 went to $500,000. So now the guy who goes and buys that $500,000 house that was only worth $350,000, his payments are twice what they were when it was $350,000. So the housing business has stopped dead, and the banks are losing money. They can't write mortgages. They're losing money on mortgages. So they're losing money on their bonds, their mortgage-backed securities, which they're keeping on their balance sheet. They're not disclosing. And on the other hand, they can't write mortgages. The banks are tightening because every mortgage they write, they're losing money. And now the housing market, you got to reduce the price of your home by 40% to sell it. So a person who now has to pay, instead of $1,200, you got to pay, I don't know, $2,000. They can't afford it. That's what, a 70% increase? They can't afford that. So the banks are in deep trouble because they're not going to write mortgages. And the mortgage they have, they're losing money on. They're hoping people would foreclose on a mortgage they gave them at 2.4% because they're losing money. So the banks are in deep trouble. But yet, when they reported the banks this week, everything was fine. Oh, look at, they're just making so much money. So that's a big problem there too. I could go on all day. So we're being lied to. So that's why it's important. Here, take a look at this chart right here, Bank of America. My gang members use my charts I designed. We designed these charts. My team and I designed these because we follow the money, not the bullshit. And look at Bank of America. It turned red for us. You have a typical stock. It looks red, green, red, green, red, green, gray. You don't know what the hell it's doing. And then the guy from Fake Business Network called, oh, he's on TV, CNBC or whatever. Oh, they're doing great. Everything's terrific. The consumer's strong. But my chart, Bank of America, keep shorting it. See it? Keep shorting it. That's the beautiful thing about my chart. So for more information, information on the stock market, on our color-coded chart, if you want daily updates on the market, just click the link in my bio, and we'll help you. Okay? So, because this is what's going on, and that's why this market, I'm going to show you right now, one last time right here, this market is going to crash from where we are today, down through that October low, And we're going to go right down to that March 2020 low. That's what they call the pandemic low. From January down to here is 50%. We're already down about 20%, I think it is. But we're going to end up down here because there's no way these banks that lead the market can hold. And the tech stocks can't keep going up. Do you know this earnings quarter we're in right now? That 30% of the earnings that they're reporting in this quarter are coming from 3 of the Magnificent 7 stocks. If you took those out, there'd be no profits, no earnings, nothing. Okay, that's it. I'll see you on the charts. Have a good day.